What is the difference between getting a pre-approval and going through the underwriting process? Hi guys, my name is Sandy Giff. I'm a licensed realtor here in the Central Florida area and also a licensed loan originator. So let's jump into it. We hear these terms all the time: pre-qualification, pre-approval, and the loan has to go into underwriting. What does all three process? What does it mean? What are we doing in all three process? So let's first talk about the pre-qualification. A pre-qualification is where a lender will take, you'll go to a lender, or a loan originator, I should say, loan originator or a lender or a mortgage broker, either one. You're trying to get a mortgage, you're shopping around, you're talking to various people. So the pre-qualification is where they're going to do a soft pull on your credit and give you a preliminary approval without actually checking all the things you're saying. So let's pretend you went to your lender and you said, okay, I'm looking to buy a home. I make $100,000 a year. My debt is XYZ. How much do you think I could qualify for? But I don't want to, I'm not serious. I just want to have an idea. They'll do a pre-qualification where they'll do a soft pull on your credit. Based upon the income that you give them, they're going to give you a price. Okay, you may qualify for that. That's a pre-qual. A pre-approval is when you go to the lender with the same thing, but this time they actually check everything you're telling them. So they're going to do a hard pull on your credit. They're going to check the income. They're going to want to see pay stubs and all that great stuff. Maybe they also will want to see your bank statements to see what amount of money you have in the bank. They will need to do that. And that is where you get a pre-approval letter. So the pre-approval is stronger than a pre-qual. Because the pre-approval is saying, this is a strong buyer. We did check all of this information and we know for sure we could lend this person, let's say $500,000 to purchase this home. That's a pre-approval. Now, once you get a pre-approval, you're going to have a pre-approval. You're going to go look for your home. You're going on the contract. Now they need to process the loan. So at this point in time where you have a sales contract, the offer is accepted, you and the seller signed off on the contract. You do an inspection, and now it is time. So now it is time for you now to actually get the loan. This is where underwriting comes into play, because now the loan originator is going to gather all the information you gave them, the pay stubs, the bank statement, your copy of credit report, all that stuff, with a copy of the contract and a copy of the appraisal. So the appraisal would have been done, and that goes into underwriting. What's the job of underwriting? The job of underwriting is now this underwriter is going to see, are we really going to give this person this loan? And is everything this loan originator is telling me about this loan or about this person to grant this loan, is this really true? So they're going to go through everything, and that's where you're going to get the request of additional items that they need to complete the loan. They may want, maybe you gave your pay stubs a month ago. They may want recent copies of your pay stub. They may want the most recent bank statement. Maybe the loan originator didn't get your tax returns. They may want a copy of your tax returns. If it's a bank statement loan, they're probably going to want 6 or 12 months of bank statement so that the underwriter could see all the funds that comes in and out of your bank account, all that great stuff. When the underwriter is examining the appraisal report, they might want the appraiser to go back and check for certain things based upon the loan. If it's a government-backed loan, like a FHA, VA, or a USDA loan, it's going to be more constringent on the inspection report, on the appraisal report, on the appraisal, the inspection report too, but more than likely on the appraisal, because if there's any peel in paint, if there is a missing step, if the handrails isn't correct, if there's no GFCIs in all of the sink areas like the kitchens and the bathrooms, let's say one of the bathrooms is missing a GFCI, and if it's a FHA or VA or USDA, they may send you back out there to correct that. Not send you back, but they might send the report back for the appraiser to have to go back out for the seller to correct the situation, and the appraiser is going to have to go back and re-examine. Maybe there's missing smoke detectors, maybe there's missing carbon monoxide detectors, whatever it is. Sometimes the appraiser have to go back to check on those things. So this is the whole underwriting process. The whole underwriting process is to figure out, do you really qualify for this loan, and is the lender now going to take a risk in lending you this money? Do they feel confident that if they lend you this money, you'll pay it back? This is the reason why your real estate agent and your loan originator will always say to you, don't buy anything while you're in the process of buying a home. Do not buy anything meaning on your credit card. Don't buy anything on your credit. Don't mess up your credit report. So don't buy anything on your credit card. Don't finance anything. Even if you want to buy the new car, the new furniture, wait until the day you close. Don't do any of that stuff, because all of that will affect it. Another thing that will affect the underwriting process is if you switch jobs or got fired during the process. Like example, during COVID, a lot of people are being furloughed. If you're furloughed or let go on your job, then you can't afford to pay the mortgage. And if that's what you were using as collateral for the loan, then they're not going to give you the loan, of course. So these are things that you're going to bear. Those are the stuff that the underwriter is taking into consideration. So you're wondering, what's the difference between the loan originator, the lender, the underwriter? So the loan originator is the person that takes all the information you're giving them. They do the application for the loan. Then they're going to have to pick a bank. Which lender are they going to use to give you this loan? Especially if it's a mortgage broker. Based upon that, they're going to send it into the lender, and the lender is going to have an underwriting department, and that's where we're going to get into all these details that I just mentioned. I'm going to do a more detailed video next time on this, but so far, this is going to be part 1 because it's a lengthy process. Thank you for watching. I'll see you in the next video.